Hey there, Wealth Press subscribers, viewers, traders, and investors. It's time for another midweek update, and I am joined as usual by Mr. Lance Ippolito. Lance, how are you doing today?
Good, good. How are you, James?
You know, I'm rocking the free world over here. We're digging into long, cold winter up here in Canada, and just going to sit back and make some money in the market. And I thought maybe you could help me out there. I'm pretty green behind the ears when it comes to option trading. I'm more of a long-term investor type. But since I got nothing better to do, I thought, I think it's time to start getting into the options. So where does a guy like me get started?
The options market has never been more popular, and there's never been more of a demand for options trading. So I would say, James, if you're looking to get started with options, there's a very good website out there with a lot of trading education, and that's Wealth Press.
No, say it isn't so. What Press teaches options trading?
Not only on the website, but there is many YouTube videos on the Wealth Press YouTube channel with some fantastic option education courses. And if you become a member, options trading is in the members area for all of my programs too.
Is that right? So now I just want to clarify here, because it's like I've gone to a few option trading advisory sites, and right away there's all this gobbledygook and all these weird diagrams and everything. And I'm just like, I don't know. I want somebody to tell me what to buy, when to sell it, and what should be my expectations and what is the risk. Is that something that you provide, Lance?
Yeah, so let's actually try to dumb this down as basic and not get too deep into it, but just the beginner of it right off the bat. So let's say you wanted to buy 100 shares of Apple, we'll say, right? Normally you just go buy 100 shares and that's it, and hope Apple goes up. Let's say Apple's at $200 and maybe you want to sell it at $220, so a 10% gain. In the options market, all you're doing, instead of buying that 100 shares of Apple stock, you're buying a call option. So a call option's betting that the stock will go higher. So calls, think of stocks going up, puts, think of stocks going lower. And with each option contract, you're controlling 100 shares of stock. So therefore, you would just buy one option contract if you wanted 100 shares of Apple stock. And let's say you still thought Apple was a good buy at 200 and a good sell at 220. The only main difference is when you trade an option, you have an expiration date. So you have to give yourself a time period of when you think Apple will go from that $200 to $220. I think that's probably the thing that gets people confused in options, is the expiration date, how to pick the correct expiration date and the strike price, instead of just going, like you said, buying stock long term and holding it.
Fascinating. So now let's say, so here's an interesting, yesterday, Boeing announces that they've been approved to fly the 737 again. So right. I think, oh, this would be a hell of a day to buy Boeing stock. And so I thought, well, I got to log into my trading account, and the password had somehow got screwed up, and so I couldn't. And it's a good thing I didn't log into my trading account, because if I would have bought any Boeing stock, I'd be sitting on a loss by the end of the day. And I was thinking to myself, well, if I wanted to make that bet with less risk than the full risk of the money it would cost to buy the shares, then I would buy a call option on Boeing, and I would assume that I want to sell it at the end of the week if I was convinced that the news that Boeing could fly the 737 was going to start the stock on an upward trajectory that was going to last at least a week. Is that right?
Correct. So with options, when you buy, let's say, a call option, the max you can lose is the amount you pay, or the premium you pay for that option. So that premium, though, and remember, when you trade options, you're getting extra leverage than stock, since each option contract controls 100 shares of stock. So I actually just pulled up Boeing, and yesterday at the open, it was trading around $220 a share. it closed just over 200, around 202 or so. So let's say that's a 10% drop in the stock. Right now it's 203. So 10% loss in the stock just from that day. Okay, that's, it sucks, obviously. But let's say you bought a call option. Let's say you bought the next week Boeing 220 strike call option, and let's say that was $10, right? That option might have gone with that 10% drop in the stock from $10 to maybe $5. So that would be a 50% loss. And just off that 10% drop in the stock. So you see how options, obviously you can make a lot of money when you're right, but it's a double-edged sword because, you could be down 50% in that position.
Ah, interesting. So that's the confounding thing about options to me is it's like you've got so many variables to consider. It's not simply put your money down and see which way the stock goes and decide when to sell it at a loss or sell it at a win.
Right.
It's got all these little nuances that can flavor the experience. So like, okay, so Boeing closed down 10% yesterday. If I'd have bought the options expiring next week, I'm not necessarily down 10% next week. It could still go back up above 200. It could go through 220, and then I'm in the money.
Right.
So on the one hand, options give you the ability to remain exposed, even though I might lose 50% of my money, but I'm only putting $10 at risk as opposed to $200.
Exactly. So the risk versus reward is very, very favorable in options trading. But another thing you have to think of, options are supply and demand. So yesterday, when you heard the news on the of Boeing coming out when it was up, around 220, the stock was up. So therefore, demand a lot of people are looking at it. So what happens to the price of the options is they go up in value. So demand drives prices higher. That implied volatility is going to be high because everybody wants a piece of Boeing. Well, when the stock starts to drop and people are like, oh man, I don't want these options anymore, that demand goes down, you start having supply. So that implied volatility drops. So therefore, the price of the options drop. And to throw it on top, your deltas are getting lowered. And the main thing with short dated options is you have time decay or theta decay. Since those options expire next week, each day that goes by that Boeing doesn't get closer or above that 220 strike price, those options are going to dwindle in value. So timing with options is really, really important compared to, just buying stock where, you have an infinite time horizon. You can control when you want to buy more, when you want to sell it. There's no, basically, there's no countdown of expiration, that clock ticking.
Right. Okay. And when you say the deltas are going down, what exactly is a delta?
So for how much the option is going to move with each dollar increment up or down with the price of the stock. So when you start buying like an in the money or an at the money option, those are going to have higher deltas. When you start buying out the money options, so let's say Boeing was at 220 and you're buying the 260 calls, even though Boeing may go up a buck or two, those options aren't going to move drastically. But at the same token, those in the money or at the money options are going to be a lot more expensive than, let's say, a cheap 240 strike call option next week. So it really depends on how much you think Boeing can go up in that time frame. If you think Boeing's just going to go from 220 to, let's say, 230, okay, you can buy an in the money option and try to get that $10 move in the stock. If you think Boeing's going to go to, let's say, to 260, something crazy like that, then you're better off buying an out the money option because you can risk a little bit of money and really make that huge, huge return.
Huh. So the biggest bang for the buck in an option win is when you bet drastically against the crowd. So you buy an option that nobody's looking to buy, making a bet that everybody else thinks is wrong. For example, if I bought an option today thinking that expired in 1 month, and I thought that the bet was that Boeing was going to be $500 a share in 1 month, I would be the only guy, maybe, or at least among a very small number of people who would be looking to buy such an option. And I would pay very little for that option, wouldn't I?
Correct. Correct. You know, the main thing in options trading is when you catch uh that big aggressive move in the right direction. You know, when you think that major either news event or some kind of event that pops up out of the blue that catches the market makers, the guys controlling the price of the options, um, off guard. So, like for example, you know, if a stock has earnings upcoming, well, the market makers are going to price the options a lot. They're going to jack up the prices because earnings are a big event, right? You'll have a stock like Nvidia with about a 7% move on earnings or so. So they're going to make those options really expensive. So let's say Nvidia moves up 7-8% on earnings, those options aren't going to pay. It was already implied. But when a stock is, let's say, flat, and then all of a sudden, boom, major news hits. Maybe it's a buyout. Maybe it's an analyst upgrade. Maybe it's some monthly sales report. And that gets that stock going up, let's say 10%. Those options can explode. You know, they could be up 100%, 200%, 300%.
Okay. Well, I tell you what, Lance, I'm going to take 2,000 US dollars and I'm going to stick it in my options trading account on BMO. And
There
then
you
I'm going to
go.
subscribe to one of your services and see if I can turn that money into more. So which service do you recommend for a guy like me who's not a market neophyte, but certainly has zero experience trading options?
Well, here, let me give you I actually just got this text Monday when I was in Miami because, you know, a $2,000 account, it's a small account, but you could still make money. My buddy Dennis texted me. He goes, $620 this morning. He actually was trading Boeing. He sent me some screenshots. $500 account now, $2,500 plus. So it's pretty cool that. And Dennis has been a member of Blitz for, I would say, months, a few months now, maybe 5 or 6 months. So if you do have, you know, a small account, let's say $1,000, $2,000, $4,000 account, I usually trade really cheap options. So I like the options under $1. So
Yep.
therefore, you know, let's say it's a dollar option. You want to buy one contract. It's only going to cost you $100. I really like that risk versus reward, especially if you have a small account.
So would it be advisable for me, so I can buy options where I have a very strong feeling that the stock is going to start rising incrementally over time, and I think it's going to basically triple within a year. So would I be buying options every week just ahead of that rise, or would I buy a year dated option way out on the triple to maximize the gain of one option and just wait for a year?
So the longer the expiration date, the more expensive the options are going to be. So let's say options expiring in December, they're going to be cheaper than options expiring in March of 2021. So you're definitely paying for that time for the trade to work out. So usually what traders do is, let's say they think stock XYZ is going to have good earnings in late February of 2021. They would go out to at least March to capture that earnings event, right? And at the same time, those options are going to be priced a little bit more because the expiration captures that earnings event. So the market makers usually have access, and let's say it's an analyst date or some kind of conference or some earnings event, they'll usually jack up the option prices to capture that event. So very rare, unless like a company moves their earnings date or so, will the options be mispriced, as what we say. But you always want to make sure you're buying yourself time for the trade to work out. That's a key, because a lot of people, when they get into options trading, I feel like they go and they say, "Wow, I can buy a Facebook 180 call option for 30 cents, but it expires in 2 days," right? And if Facebook doesn't shoot up past that 180 in 2 days, those options go worthless and they lose their entire premium they paid. So really, buying time, it is definitely something that will make you win more than you lose, we'll say, than the cheap weekly
I see.
options.
Okay, interesting, Lance. Well, this has been very, very informative. I'm going to go ahead and deploy a little bit of capital, and we'll see how I did next week. So thanks for joining me today, and wish me luck.
For sure, James. Options trading, it seems very overwhelming at first with all these terms and Vega, Theta, Delta. But in reality, once you get it down, it might take a few weeks, a month. Thankfully, the education, Wealth Press, and the YouTube can be helpful. But once you get it down, you'll get the hang of it. It's like riding a bike. You'll be able to do it on your own and get right back on.
Beautiful. All right. Well, we'll see how I do then. Thanks very much for joining me, Lance. We'll come back to you next week. Have a fantastic weekend.
You as well.